Hello everyone, in this video we are going to start our next section of ACCA FM syllabus, and that is working capital. Working capital is one of the most important topic when it comes to exams, and it's quite unlikely that in any attempt it will not be examined. So pay very close attention to it, and it's not that much of a complicated thing. So it's quite an easy mark to gain over here. Now, working capital in your lecture notes goes from chapter number 4 to chapter number 7. So let's start with it. If you come to the page number 33 of your lecture notes, we have got the start of chapter number 4. The name of the chapter is itself working capital. So let's see what working capital really is. Working capital of a business is a current assets less current liabilities. Simply put, in a definition, basically working capital is made up of 4 components. For beginners, that is inventory, receivables, payables, and cash. These are the 4 elements of working capital. We'll be looking at them, each of them in due turn. Now, if you come to the second point, we have got different businesses have different working capital characteristics. Some businesses tends to hold inventory while others do not. It's quite obvious that the inventory turnover or inventory holding is a part of a strategy for most businesses. Now, most businesses such as car manufacturing, they tend to hold a lot of inventory as work in progress because before they made the final good and dispatch it to the customer. Now, however, this might not be the case in the retail sector, where goods are mostly perishable nature and they have got a very high turnover rate, which means they have to order the inventory again and again from time to time so that they can display it on the shelf to be bought by the customers. Then we have got taking time to pay to supplier and other account payables is one of the strategies of the business to take goods or supplies from the suppliers and pay them in a few days or a month depending upon the agreements with the supplier. It's an easy source of finance because the more time you have available to pay to a supplier, the more time that cash can be present in your premises so that you can gain a benefit from them. Then we've got allowing customers time to pay. Now, here what we do is, in order to gain the market, most businesses, especially startups, what they actually do is that they give their they give their goods or services on credit to the customers so that they can pay with their own ease. It's one of the most basic strategies to enter a new market. Now, after that, we've got the 2 objectives of working capital management are to ensure that it has sufficient liquid resources to continue in business and to increase its profitability. What is working capital? What are we here to do? Basically, the why this topic is incorporated in the FM syllabus is because the examiner expects financial manager, or you can expect from financial manager, that they have got a good grasp over these elements so that they can manage between profitability on one hand and liquidity on the other. Liquidity implies that business have enough current assets in its premises so that it can set off its current liabilities when they become due. However, profitability implies that the business, instead of holding the funds in its premises, should invest it if it knows already that it might not be using those funds in let's say 2 to 3 months. It's better to invest them somewhere and earn a return than just to keep it on your premises. So these are the 2 things between which the financial managers have to keep a balance. Then we have got a business should have a clear policy for management of each of to increase its profitability. Now, businesses should have policies to manage each of these components of working capital. We will be learning about these as they come by. First topic, over here is cash operating cycle. It is also called with the name of working capital cycle, cash conversion cycle, or trading cycle. So don't get confused with the name. It all means the same things over here. Now, cash operating cycle is the period of time which elapses between the point at which the cash begins to be expended on the production of a product and collection of cash from the purchases. Now, it basically implies the point. What is cash operating cycle? It will tell the duration from first point to the end point. Now, first point would be the point at which you obtain the supplies, then you paid the supplier, did the production, and eventually the time it took for the business to generate the sale and gain the revenue in the form of receivables. So it's the whole cycle from the initiation point to the end point. If you look at the performer over here, that's how we will be computing the cycle of a working capital. That is raw material holding period, work in progress holding period, finished good holding period. Now these combined, these three can be called as inventory period. Then we've got account receivables collection period, the time it takes for the receivables to pay to the business, and then accounts payable payment period, the time it takes for the business to pay to its suppliers. Now note over here that the payable period is always a negative, so be careful over there. Most students make this silly mistake. And when we compute all these, we have got a cash operating cycle. There's an example over here as well. The following has been calculated for Henry Co. Receivables days 58, inventory turnover 10 times per annum. And then we got a payable days of 45 and non-current asset days of 36. And the questions require us that what is the length of the cash operating cycle. So let's compute that. I've already put the example over here. Firstly, we are computing cash operating cycle. For that, we first need inventory days. Now, we are not given with the inventory days over here. However, we are given with inventory turnover. Use your common sense over here. There are 360 days in a year, and the inventory has been replenished 10 times. The inventory has been replenished 10 times. So all we need to do is to divide 360 with 10, and the answer over here is 36. We have got our inventory days. Working capital is more about using your common sense. Then we have got receivable days. As per the performer, and luckily we have already have the receivable days in the example, and that is 58. Then we have to include payable days. Now, as I've just told you, payables will always be in negative. And we are already given payable days over here, that is 45. All we need to do now is to compute them, and the answer becomes 49 days. This is our cash operating cycle of Henry Co. Coming back to our notes. The next topic that we have now is ratios. Now the ratio analysis we have already covered in chapter number 1. So do watch that lecture. will just be going through very fast with these ratios. First, we have got a current ratio. Now, a company should have enough current assets to set off its current liabilities. A ratio in excess of 1 should be expected. Just written over here. Basically, what this ratio is all about, it's the comparison between current assets and current liabilities, and the ratio is obvious, should at least be 1:1. If the ratio starts to fall below 1, which it means that its current liabilities are increasing significantly, and it's quite obvious that if a business is unable to set off even its current liabilities, its going concern assumption becomes questionable, and it's quite likely that it will be filing for protection from creditors soon. So that's for current ratio. This ratio should be at 1 at minimum. Then we have got quick ratio. Now the quick ratio should ideally be at least 1, just like a current ratio. For companies with slow inventory turnover, as I've just told you in the example of car manufacturing. For companies with fast inventory turnover, like in a grocery store, a quick ratio can be less than 1 without suggesting that a company is in cash flow difficulties. Now here, the formula was current assets less inventory divided by current liabilities. We are taking out the impact of inventory over here, so it can be less than 1, however, but not significantly less than 1. So that is for current ratio. However, in this slow inventory turnover scenario, we expect that the quick ratio, just like the current ratio, should at least be 1. Then we have got account receivables. An increase in this period indicates increase in investment in working capital, length of time taken by the company's account receivable to pay what they owe. This basically implies the average number of days the customers held our money, which we have generated of sales. The formula was quite simple. Receivables over sales, credit sales, multiplied by 360 days or 365 days, depending upon which assumption you use. And that's how we computed the receivable payment period. Then we've got inventory turnover period. This indicates average number of days that items held in the inventory. A lending inventory turnover period indicates a slowdown in trading or build-up inventory level. If you observe it carefully, it's telling you the basic thing. If I tell you that the inventory turnover days are decreasing, it's obvious that it means that our sales of the inventory have been declining, which means our products are not being demanded by the market, or we are making so much inventory that it starts to build up in our premises. So these are the things which this ratio shows. The computation of this ratio was also very simple. Inventory over cost of sales multiplied by 365, and that's how we computed the inventory days. Then we got account payables payment period. Just like the receivables days, it tells us the amount of time we took to pay back our customers on average. This period often helps to assess a company's liquidity. An increase in account payable payment is often a sign of lack of long-term finance or poor management of current assets, resulting in extended credit, bank overdraft, etc. If getting the source of using payables as a source of finance is quite common, however, if a business starts to use this option substantially over its operations, then it means that the business lacks long-term financing and heavily relies on its credit availability from suppliers and bank overdrafts. So that might not be the good sign. Whenever you do the ratio analysis, you have to observe all aspects of a company. Then we got the net working capital ratio. Now this ratio must increase in line with the sales to avoid liquidity problems, and this ratio can be used to forecast the level of working capital needs. The formula which we learned of this ratio was sales over current assets less current liabilities. That's how we calculated this ratio. Now This ratio, what it should show, that it should increase parallel with the increase in sales. This is almost the same percentage, more or less, but not with a significant deviation. What it does is actually funds the extra requirement of the fund which is needed to generate those extra sales. Since sales are increasing, it's obvious that more resources needs to be utilized and purchased to produce those products or services that needs to be sold. And that's why more investment in this working capital is needed. Then we have got working capital needs of different types of businesses. Now, businesses with a lot of cash sales and few credit sales should have a minimal account receivables, just like in the retail store I've given the example to you about. Then we've got a business that presents solely to trade with only have finished goods in its inventory, whereas manufacturer will have a raw material and work in progress as well. Now, when you talk about grocery store or mall, for example, let's suppose there's a mall, a very famous mall, in which you go to buy clothes. Now the shop owners over here, for their own business model, they do not need to make clothes. They mostly purchase it from their suppliers, which are the big manufacturing factories, and then they display it on the shelves or on the shops, and you pick them, select it, and buy it from them. So for a business, for a shop in a mall, you have got their business model is quite straightforward. They do not need to keep a lot of inventory in their premises, like unstitched clothes. However, this will not be the case when it comes to when we talk about the factory that gives them those clothes. They have to keep a lot of stock in their premises because they have to continuously produce and manufacturing the clothes which are required by their customers, which are the shop owners in the malls. Then we got businesses that present solely for trade, I've already read this point. Then we got large companies may be able to use their strength as customers to obtain extended credit period from the suppliers. Now, the size of a company always have an impact on the trade agreement. The larger the size of a customer or a supplier, which it means that the larger bargaining power is still towards them. So in this case, if a large company uses its size as strength on its customers to obtain a trading period from its suppliers, and that's how they do that. What they do is they themselves are a big customer of a supplier. This supplier is not that much of a big company, so what they do is they use their size to obtain extra credit or perhaps a discount or low prices. They influence their suppliers to get the benefit out of them. Then regards, some businesses will be receiving most of their monies at certain times of the year while incurring expenses throughout the year. Now, if you talk about, let's say, Christmas tree manufacturing company, what they do is they produce throughout the year, but their sales normally happen at Christmas. So they have to produce throughout the year to make goods available in the market, and they stock up all those goods, and when the time the Christmas comes, they release all their goods into the malls, which from where people buy them, and then they decorate their houses with. Now, in this model, the business is incurring the expense throughout the year. If you compare the profitability of one quarter to the next, you will be shocked that that it will show a very substantial loss. But however, if you compare it year by year, you will see or observe a steady growth in it. Then we've got overcapitalization and of working capital. Now, if there are excessive inventories, account receivable and cash, and very low account payable, there will be an overinvestment by the company in current assets. Working capital will be excessive, and company in this respect will be overcapitalized. Comparing year to year, we have got indicators as well over here. Now, overcapitalization basically implies that we are putting too much funds in our current assets, which might not be needed at that time. As a result, we are just wasting our resources in our premises. Or what we could have done is use those resources to obtain benefit. Instead, we are just wasting it away in the form of working capital. What we are doing over here is that we are putting a lot of inventory in our premises. We are giving extended credit to our customers and putting a lot of cash on premise or in bank account, and we are paying our suppliers very soon, that instead of paying later, we are paying them quite soon, despite the fact that we have got a credit facility. So a lot of fund is utilized or is stuck in this operation. So in this respect, what we call a company using this strategy, we call it as that is being overcapitalized. It could have utilized those funds, give their customers a reasonable receivable period, or keeping an appropriate level of inventory or and cash in its premises or in bank, and then utilizing those resources or in the form of funds and deposit in a bank, or put it in put it like invest in somewhere to gain a return out of it, instead of just putting it in a premises. Now, there are a number of indicators to show that the business is heading towards overcapitalization. Firstly, we will show the working capital and sales compare year to year or with other companies. It starts to show increase in working capital. However, the sales figure might not show that much increase. As I've just told you in the ratio analysis of this area, that working capital should go hand to hand with the increase in sales. Then we got liquidity ratios comparing year to year or with other companies. Liquidity ratios can be compared with the last year as well as with the industry norms. To see the best available information is the industry norm. So if we compare it with an industry average, you will see that if they are investing substantially in its working capital, if their receivables are substantial, if their inventory is substantial as compared to the industry average, it's obvious that they are moving towards overcapitalization. Turnover period, long turnover periods for inventory and account receivables or short credit periods from suppliers may be unnecessary. As I've just told you, that despite the fact we have the option of obtaining the credit facility from our suppliers, we tend to pay them very soon, which might not be needed, and giving our customer longer time to pay us the money for the sales. So this is also an indicator of overcapitalization. Now, a few moments back, I've told you that the financial managers should need to keep a balance between liquidity and profitability. In this case, you can clearly see that there is a liquidity, but there is no profitability, which means the balance is out. In this strategy, the business is focusing more on liquidity rather than profitability. Then we have got overtrading. Overtrading is when a business tries to do too much too quickly and with too little long-term capital, so it is trying to support too large volume of trade with capital resources at its disposal. Now here what the business is doing is their sales is increasing, their demand of the product in the market has shown a great promise, and as a result they focus solely on manufacturing and then using investing substantially in working capital for the manufacturing of the masses. And as a result, since it's obvious that they might not be able to obtain large sums of money at once, they rely heavily on bank overdraft or obtain loan from the bank, which becomes easily available. As a result, what they observe actually is that they put their money into the business by obtaining loan. They put their loans into the business, They double the shifts, they put strain on it, on their non-current assets, to produce the resource, to produce the products that are demanded by the market. And in the end, when they compute all that to gain, so that they will know what is the profit figure, they will be surprised to know that most of their profits are wiped out by the payments to the bank. They did not take this into account, that the obtaining those funds means that they have to pay for it in the form of principal, and also they have to pay for the risk taken by the bank in the form of interest payments to them. So most of their profitability is wiped out in the form of interest payments. That's the scenario through which you will be able to understand overtrading. There are indicators of overtrading: rapid increasing in sales revenue. As I just told you, there will be a rapid increase in sales revenue in the example as well. Then we got rapid increase in volume of current assets and possibly non-current assets. To sustain that demand, it will show that business has a massive investment in its current assets and also in non-current assets. Inventory turnover and account receivables turns overnight over, and account receivable turnover might be slowed down. Their receivables might not be that fast, or inventory turnover might not be that fast. They might be purchasing in bulk to stock up the premises. Then we got there is only small increase in proprietized capital. The increase in asset is financed by credit, especially trade account payables and bank overdraft. It's obviously the profit, the net profit figure we arrive at goes to the reserve, and that reserve is utilized to fund our next year with more money at our disposal. So what happens in this area is that there is only a small screen, since we don't have that much time to sustain the amount of capital that is needed to fund that kind of massive demand, to produce that kind of massive demand, to produce those kind of products. What happens over here is that their debt to equity ratio starts to get disturbed, and as a result, more of their capital financing is via debt rather than equity. And in this case, they rely heavily on obtaining credit from the bank and obtaining credit from the suppliers, extended credit period from the suppliers. Then we got some debt ratios or liquidity ratios alter dramatically. The proportion of total assets financed by proprietors' capital falls, as I just told you, that the debt to equity ratios starts to get disturbed, and most of the capital invested to fund the operation will be from debt rather than equity. The current ratio and quick ratio falls. We already know what current ratio and quick ratio is. They start to fall, which means that the current liabilities starts to increase. The business might have liquid deficit, i.e. excess of current liabilities over its current assets. Doing too much too fast means there is an excess of current liabilities over current assets, and when this scenario happens, you know that this business is heading towards overtrading. Now that we have discussed all these points, let's read out the definition again to have a very clear picture about overtrading. Overtrading is when a business tries to do too much too quickly with too little long-term capital. So it is trying to support too large volume of a trade with few capital resources at its disposal. So that's it for this chapter.